Welcome to Global World Watch. Please subscribe and press the bell icon for more updates. The world is witnessing a new kind of conflict, one waged not with tanks, but with capital and code. The United States and China, once economic partners, are now rivals reshaping the global order. The old belief that economic ties would prevent conflict is crumbling. Tensions have moved beyond tariffs, now threatening the very foundations of global finance. The symbiotic relationship, China making goods and buying US debt, America consuming and investing, is unraveling. Washington sees Beijing as a strategic threat, prompting tech bans and investment blacklists. Financial markets, once symbols of stability, are now battlegrounds in a clash of values and interests. Wall Street's optimism about China has turned to caution. Political risks now overshadow profit. The rush to enter China has become a strategic retreat as banks and investors reassess their exposure. The rules of global finance are being rewritten, and no one is immune from the fallout. The era of financial Cold War has begun, and the world is bracing for impact. Wall Street's giants are pulling back from China, not in panic, but with cold calculation. Banks like Goldman Sachs and Morgan Stanley are moving staff and capital out of China and Hong Kong, downsizing teams, and shelving expansion. Decades of deepening financial integration are reversing. Geopolitical tensions and US regulations have made operating in China a legal and reputational minefield. Compliance risks, potential sanctions, and asset seizures are now real threats. China's own policies, crackdowns, state dominance, and a slowing economy have soured the investment climate. The promise of endless growth is gone. The risks are too high. Banks are relocating to safer hubs like Singapore, de-risking their portfolios and becoming selective about Chinese deals. This is more than a business move. It's a verdict on the future of US-China relations. The era of unbridled financial globalization is ending. A chilling rumor haunts Washington and Beijing. China could dump its $1.7 trillion in US assets as financial retaliation. For years, China's treasury holdings stabilized both economies. Now, that interdependence could become a weapon, flooding markets, spiking US interest rates, and shaking global confidence in the dollar. The so-called $1.7 trillion revenge dump would be a financial earthquake. Such a move would raise borrowing costs across the US economy, from mortgages to corporate debt. The threat alone is a powerful tool, signaling Beijing's willingness to strike back if tensions escalate. Whether China would actually pull the trigger is uncertain, but the risk is now part of the geopolitical arsenal. The threat of a Chinese debt dump is a high-stakes game of chicken. Both sides know a financial collision would be catastrophic. If China sells, it crashes the value of its own assets and risks massive losses. There's nowhere else to park such vast sums safely. Alternatives like the euro or yen can't absorb the shock. A weaker dollar would make Chinese exports less competitive, threatening jobs and stability at home. China is trapped. Selling hurts itself as much as the US. For America, a sell-off would spike interest rates and slow the economy, but the Federal Reserve and global investors could step in. The US dollar's reserve status offers resilience. In this standoff, both sides would suffer, but China may have more to lose. The financial weapon is powerful, but using it risks mutual destruction. So far, both sides are holding back, wary of the fallout. This isn't just a battle of superpowers, it hits your wallet too. If China dumps US debt, borrowing costs for homes, cars, and credit cards would rise worldwide. Higher interest rates squeeze families and businesses, slowing growth and hiring. Governments would pay more to finance deficits, straining public services. The dollar's value could swing wildly, hurting US exports and destabilizing emerging markets with dollar-denominated debt. Global supply chains would fracture, forcing companies to rebuild at higher costs. Prices for everyday goods would rise, fueling inflation. Innovation and economic dynamism would suffer as the world splits into rival blocs. The financial Cold War could make life more expensive and less secure for everyone. The ripple effects would be global and personal. As China becomes riskier, US banks and companies are pivoting to a China plus one strategy. They're keeping a foothold in China, but expanding into Vietnam, India, Mexico, and Malaysia. These countries offer new growth, but also come with their own challenges: regulation, infrastructure, and political risk. Banks follow their clients, opening branches and building networks in these emerging markets. The shift is costly and complex, but necessary for survival. No single country can replace China's scale, but diversification is now essential. The global economic map is being redrawn as capital migrates. This great migration is fragmenting the world economy, but may also make it more resilient. The era of relying on one manufacturing giant is over. The search for new frontiers is reshaping global finance. In the US-China financial split, Singapore has emerged as the big winner. With its stability and rule of law, it's become the new safe haven for Western banks and investors fleeing Hong Kong's uncertainty. US firms are relocating regional headquarters, wealth management, and trading operations to Singapore. The city is booming, attracting talent and capital from across Asia. Hong Kong's autonomy has eroded, making it too risky for global finance. Singapore offers a business-friendly, English-speaking environment, without Beijing's direct oversight. The influx is transforming Singapore into Asia's premier financial centre. But the boom brings challenges: rising costs, social tensions, and the need to balance US and Chinese interests. Singapore's ambition is to be a neutral bridge in a divided world. Its rise is a symbol of how capital adapts to new geopolitical realities. At the heart of this conflict is the fate of the US dollar. For decades, the dollar has been the world's reserve currency, giving America immense power. Now, China and others are pushing to reduce their reliance on the dollar, so-called de-dollarization. China is promoting the yuan in trade and building its own payment systems. But dethroning the dollar is tough. The yuan isn't freely convertible, and the euro is hampered by fragmentation. The dollar's dominance persists because everyone else uses it. Still, the trend is shifting. US sanctions have pushed even allies to seek alternatives. The dollar's share of global reserves is slowly declining. A sudden collapse is unlikely, but a gradual erosion is underway. The fortress isn't crumbling, but the siege is real. The long-term impact on US power and the global economy will be profound. We're at a turning point. US-China financial tensions are reshaping the world. The era of hyperglobalization is over. Great power competition now defines global finance. The retreat of US banks and the threat of a debt showdown signal a deeper decoupling. A full-blown financial conflict could trigger a global recession, shatter supply chains, and fuel instability. The system that lifted billions from poverty is at risk. Both sides have reasons to avoid disaster, but compromise requires rare statesmanship. The unraveling of financial ties removes a key guardrail against conflict. As the world splits into rival blocs, the stakes couldn't be higher. The $1.7 trillion showdown is a test of whether shared interests can prevail over rivalry. The outcome will shape the next era of global order.